Okay, folks, hopefully we are live. I am traveling and we are live. Awesome. Let me mute my other computer here. Okay, folks, hopefully we are live. I am traveling and we are live. Awesome. Let me mute my other computer here. Come on, how do you do this? Okay, folks, hopefully we are live. I am traveling and we are live. Awesome. Mute my other computer. There we go. Perfect. Perfect. All right. All right, folks. Happy Sunday night. I am traveling and we are in Salem, PA, Salem, MA, Massachusetts, and having a great time here. Love this time of year. Beautiful area. So forgive the ad hoc setup here. I have my iPad to my left. I'm looking at your notes on the live chat on YouTube. And we are live, obviously, with the Futures Action. We're going to talk about the Federal Reserve's actions this week and what we might expect. So I do have a number of alerts we need to get to, or requests we need to get to. If you're requesting alerts, please do so in the members community. That's where we look. I have a post there in the feed where you can enter your requests. So if you're not currently a member of the Bull and Bear Banter community, link below, sign up. I'll do a refresh in a couple of minutes, and I will take your chart requests. So we have the futures open at current. Let's let them settle down for a minute. We're looking at a 5-minute chart of the Russell 2000 spiking up 0.14%. We opened up slightly higher than that earlier. Now, if I could ask folks, anybody on Franklin, especially, and Sean, if you can give me an audio check. Franklin already gave me the audio check. Thank you, Franklin. RK, welcome. I can't bring up comments because I don't have the ability to do so. Franklin, hello, and thank you again. Usually I have my camera here. Now it's here. Tim, evening to you. Sean, hello, sir. RL, the like button not working. Wonderful. Wonderful. You're right. I know. I hit the like button. It worked. It worked. Hit that like button. I'm the only one. Okay, let's get to it. Let's talk about the opening price action where the first 5 minutes in the books. Let's set up and let's get notified if we get a new session higher high. Let's take a look at the ES. ES spiking. Oh, that is down. It must be a new contract. This is a new contract. That's why it looks this way. Okay. We're down at current relative to the close on the new contract. You can see here, here's the contract. So down slightly relative to the close on Friday. NQ. NQ showing is down relative to the close on Friday. New contract here as well. YM. Flat relative to the close on Friday. Let's take a look at the US dollar. Because the dollar is going to play a large part in our conversation tonight. And we're showing is up here, yet the close was here. That doesn't look right. I think it's showing relative to the close on Friday, the dollar's flat. I'm not sure why they're showing this as positive. That happens a lot on Sundays. Let's take a look at other currencies for a moment, because the dollar is not looking well. It is looking very unwell. Here's a 15-minute chart of the euro. The euro is moving up higher, and to give you a little bit more frame of reference of what's going on in the currency market, the euro, nice rally up and into the week of the 19th of August, pullback, consolidation. I think we're getting ready for another move up higher on the euro. Now, the yen, which we've been talking about quite a bit lately, the yen has been on a tear, a rip your face off rally relative to the US dollar. This is today's price action on a weekly chart. Let's take a quick peek at the Aussie dollar relative to the Japanese yen. We know this is highly correlated to the US equity markets. They gapped us down and have now reversed us on a 15-minute chart. Let's do a deeper dive here. Let's go 5-minute. I want to know if we break below as well. Okay. Now, looking at RTY just moved above its prior high. So new highs in the session for the small caps. That leads me to believe that yields are dropping, and they are. Yields are down 0.19%. Bonds are rallying at current, and we'll be talking quite a bit about bonds tonight as well. Larry, regarding events this afternoon, to tea or not to tea, that is the question. Yeah. What Larry's referencing, what Jedi Kid is referencing, is the second attack on the life of President Trump. Is it going to impact the markets? No, it is not. It's not going to impact the markets. It's just a signal to the world that the United States is not what it used to be. We are really waning in terms of our prowess, our dominance in the globe. We can't even protect former presidents anymore the way we should have. We have stoked, or I should say the left has stoked this hatred of the man. And this is the times that we live in. They will do anything for power. And I think that it only gets crazier from here. Disaffected Canadian yield curve has been above neutral for a bit. What happens next? That's what we're going to talk about next. We're going to talk about that quite a bit tonight. So stick with us. We're going to be talking about the yield curve in a while. Let's finish up with the futures action. Let's take a look at volatility and what it is doing. Volatility is up nearly 1/3% out of the gate here. It's off the session highs. Let's check a look at commodities for a moment. Gold down fractionally. We are long of gold. We've been long of gold, but we added some futures last week. We booked a little bit of profits on Friday. 4-hour chart. A little bit of a breakdown. I'm sure we're going to rally back here. We remain very, very bullish on gold. New all-time highs last week on gold. The gold mining stocks had a rip your face off rally. So I want to know if we put in new weekly highs, and then we'll look to add to this position. Okay, that's gold. Let's take a look at silver. Silver up 0.12%. A very strong week last week for silver. Let's check out crude prices. They rebounded last week. Looks like we opened up. We faded a little bit here. Yeah, we opened up. We faded. Nat gas. Natural gas down a little over a half percentage point. I like nat gas. One of our requests tonight is go over the leveraged product of natural gas, which is Boyle. We'll be going over that in a little while. So let's leave it off with the commodities market, looking at palladium, of which we are long. Palladium had a monster week last week. Very, very nice. And we broke out. Copper. Copper had an okay week last week. We've stopped going down. Now we're putting in higher lows. We're threatening a breakout on copper. Looking at ag, corn, strong price action. Looks as though the path of least resistance is changing here. Even though we're down at current at the beginning of the week, it looks as though the path of least resistance is to the upside using a weekly time frame. Soybeans. A little bit of a stalling action last week. I'm not as bullish on soybeans as I am on corn at current. That all changes if we break out above this resistance level. Let's create an alert. And we'll wrap it up with wheat. Wheat had a monster week last week. Really nice stuff. We're up right now at the open. So wheat, it broke out above resistance going back to July. I think we're coming up to the highs of the week of June the 17th. That's at around 612 the bushel. Bitcoin. Bitcoin, we did a scalp trade on Friday. I'm going to be looking to re-enter this. I was worried about weakness in the equity markets, possibly a fade in the equity markets on Friday, and that would take down Bitcoin because they're highly correlated. Now, that didn't happen, but now that we're seeing a little bit of a fade in the large cap names, now we're getting a pullback on Bitcoin. So Bitcoin is not the new gold. It is not. It's anything but the new gold. And we want to be in gold because it is a safe haven store of value and not Bitcoin. Bitcoin is a trading vehicle. It's as simple as that. Okay, let's get to the topics we want to talk about tonight. And first off, folks, if you're not part of our community, please, the Bull Bear Banter forum is open. It's free for now. If you want chart requests, please head on over. I post right before we go live, or actually in the morning, I just posted it this morning, requests from members of the forum to enter their symbols. And you can see I have a number of them that have requested symbols. If you want them in the future, you need to do so through the forum, please. So link below on YouTube, link above on Twitter, and I'll see you on the other side. Okay, so we get to the news today. Very disappointing news. Good news in the way that he didn't get hurt, but nothing will slow me down. Trump reacts after second assassination attempt. I mean, very, very scary times that we live in. So prayers for the man, and hope to see him in the White House in January. Okay, coming out this week, we have a lot of economic data. It begins somewhat on Monday. We have the Empire State Manufacturing Survey. They're expecting a negative read here. The Tuesday data coming out, retail sales. They're expecting a negative read there as well. Capacity utilization, business inventories. You don't want to see a build in inventories. What does that mean? It means that retailers are going to have to cut prices. Home builder confidence, that has a ripple effect on the economy. And on Wednesday, of course, we get FOMC. We get the Fed chairman coming out with his press conference. Thursday, initial jobless claims. That's been moving the market of late. We get the Philly Fed manufacturing survey. U.S. leading economic indicators. These are all market movers. So buckle up for another volatile week. Now, going into Friday morning, the probability of a 50 basis point cut was at about 13%. So something has happened here, and something quite dramatic, because within the past couple of days, we've gone from a probability of a quarter basis point cut to now a probability of a half basis point cut. Now, in favor of that cut, 48%. So something has happened here, and that is what you're seeing reflected in the rally in the equity market. They're pricing in a 50 basis point rate cut. Now, looking at we'll talk more about this in a moment. Schiller PE ratio at around 36. We're at the highs of the year right now, with the highs of the year. Add to that, bullish sentiment is skyrocketing. It skyrocketed on Friday like you can't believe. That's a contrarian indicator that, you know what, something's about to break. Now, that being said, I can't just leave that out there and not acknowledge something, because it would be disingenuous. And I don't want to be disingenuous. Let's bring up a chart here we could just go with the Dow. We'll go with the Dow. We'll go with the weekly chart. And we had a very, very bullish week. We are a stone's throw away from all-time highs on S&P 500, Dow Jones Industrial Average, and, of course, the triple Qs, but to a little bit further of an extent. They need to catch up a little bit more. So you've seen some sector rotation into industrials, into other areas of the S&P 500, driving these names up. The Trip Qs played some catch up last week, but not enough to say they are outperforming the Dow Jones or the S&P 500 on a short-term basis. That could all change next week. Now, the Buffett indicator, strongly overvalued. Now, the thing to remember about when we go into events that have preceded or let's say correlated with a steepening of the yield curve and an uninversion of the yield curve, well, it's accompanied by a rally in equities. And you can go back to 1929. It's always the same. You get a rally in equities until, or even beyond, when you get the uninversion of the yield curve. And all of a sudden, things go from chicken salad to chicken poop. And it happens like that. You saw it with COVID in particular. You saw it with the dot-com bubble, especially with the financial crisis. Everybody should have seen that one coming, but a lot of so-called smart people did not see it coming. Now, looking at what the markets are sweating about, it's the question of, do we get a 50 basis point cut or a 25 basis point cut by the Federal Reserve? We know we're getting one. Which one is it, and how will the market respond? I think that if we get a quarter basis point cut, that the markets will probably roll over. If we get a 50 basis point cut, I think the knee-jerk reaction by the equity markets is going to be a relief rally, and that's consistent with the price action we're seeing on the charts of the major averages. They may even break out to new all-time record highs. The question is, do they hold that breakout? You remember back in 2007, 2008, the S&P 500 pulled back from an all-time high, rallied to an all-time high. One would have thought you were going to get a double top. You didn't. You get an overshoot or an overshot double top, and then we collapsed. So we could quite very well see that here again. It is not unprecedented. Jamie Dimon came out on Friday. JP Morgan CEO hints at a looming crisis worse than recession. Now, Jamie's been known to make these comments in the past. He speaks his mind, but it's always wise to listen to what the man has to say and not dismiss him. So if he's coming out in public and saying this, he's got a reason for saying that. You have Berkshire Hathaway, who is now seeing redemptions by some of their big investors. They're sitting in cash, a huge amount of cash, waiting for an event. Who am I to second guess? So it was earlier asked, what does it mean at current with the uninversion of the yield curve? Well, let's bring it up. So here we have it. The uninversion of the yield curve, monthly chart. We have not closed above the neutral level on a monthly time frame yet. We have done so on a weekly time frame. It's in the books. It's happened. It's done. There's an uninversion. Now the question is, where to from here? Now, the one thing I do want to point out is that you have the yield curve, which is now outperforming on a relative basis oil. You haven't seen that since back here in 2007. So I was listening to Peter Schiff on the drive up here from New York on Saturday, and Peter brought up some really great points that got me thinking. And it was a good long drive, so I had a lot of thinking I was able to do. And what I wanted to talk about on this show today, and that was, he is extremely, extremely pessimistic on the outcome of these rate cuts. And I'll be honest with you, I've said the same in the past that he has. I can't do so as articulately. I am not an economist like he is by any stretch of the imagination, but I do know cause and effect. I do know the outcomes. There will be a reaction by this market to these rate cuts, and it may not be as good as people think. Now, what might that be? Well, let's think about it this way. We'll come back to this chart in a moment. Let's think about it this way. You have the floodgates of illegal immigration that are open in this country. It is costing us billions upon billions of dollars to house, feed, transport, do whatever with them. But we don't have the money. We are financing a war in the Ukraine and now Russia to the tune of about $200 billion. We don't have the money. We are now proposing to send long-range missiles to strike deep into the heart of Russia, threatening a World War III scenario. Forget about the money. We certainly don't have money for that. But to think that this is the route, this is the path that you want to take, is World War III, is beyond insanity. So when I got up here, I did this. I typed into ChatGPT. Here's my query. What would cause both the U.S., because I knew what the answers were going to be. I wanted to see if I was going to be validated, A. B, was I missing something? What would the cause of both U.S. Treasury bond prices as well as the U.S. dollar to go into bear markets at the same time? rising inflation. We already have that. We already have that. Yes, it's coming a little bit. Yes. Aggressive monetary tightening by the Federal Reserve. They're going into a rate cut regime. What happens to the stock market if inflation goes like this, yet they're cutting rates and they have to do an about face and begin tightening again? Loss of consumer confidence in U.S. fiscal stability. I think that's a proximate cause for this. So yeah, it'll be a cascading event, but that won't be the outcome. That'll be a contributor to the decline of both the U.S. dollar and treasuries. Geopolitical risk. I just mentioned this. We have geopolitical risks everywhere. We have them in our homeland now. We have them in Europe. We have them in the Middle East. Where don't we have geopolitical risk? Diversification into alternative currencies and assets. That's an outcome of this, right? So if you have capital flight from the United States, well, of course, it's going to go into other markets. So it's not a it'll I guess it'll cascade, but it will be an outcome of the bear market in both treasuries and the US dollar. Now, under the loss of confidence in US fiscal stability, what would the US government and or the Federal Reserve do to restore confidence? This is what they would need to do. We all know this. They got to reduce the size of our debts and our deficits, and that means reduction of government. It means growth of GDP. It means slashing entitlements dramatically. Monetary policy stabilization. This is saying that they're going to need to raise rates, not decrease rates, raise rates, strengthen economic growth. So they're going to have to strengthen economic growth. How do you do that in a rising interest rate regime? Good luck. Improve fiscal credibility. The only way you're going to do that is stop spending money. Back your currency with at least partially buy gold. Have a budget. We haven't had a budget in years. They may say we have a budget, but what do? We do continuing resolutions. So this is what we're looking at here. This is where we're about to cross the Rubicon. So why I believe that we're going to get a half basis point cut is because A, the Fed Watch tool is telling us so. B, the yield curve is now uninverted and the Fed does watch it. Also, the yield curve is in red. And also the U6 non-farm payroll number. The headline is U3 that they feed you. That's what CNBC reports. They won't tell you this number. Real unemployment rate. And they used to use this as the official employment rate until the 90s. Then they changed it to the U3 report. We have about 7.5% unemployment that is known in the economy. And after 1 year, they even drop off of this report. If you're not looking for a job anymore, well, you drop off the report and then you end up on another report, probably the U7 number. So the jobless claims or the unemployment rate is moving up higher. And the not so odd part, nobody should be surprised at this, is that there is a direct correlation between the yield curve steepening and the rise in unemployment. You saw it, you're seeing it at current, real time. Back here, you saw it during COVID. Before that, you saw it during the financial crisis. Before that, you saw it during the dot-com bubble. So the correlation is loud and clear. The economy is weakening. as measured by jobs. And that's the pimp Mac Daddy of all economic data points. And U.S. job openings, this is from the Kobisi letter, something really does not add up here. U.S. job openings data has been revised downward 15 of the last 19 months, the longest streak since 2008. What happened back then? The financial crisis. The most recent release for June was lowered by a massive 274,000 job openings. We're not even talking about the 818,000 jobs that the government revised down that never existed. And remember, every time we beat on those earnings or the non-farm payrolls report, what did the stock market do? It rallied. It went up. It has never retraced due to the revision down. We saw a bump on the screen. Now all of a sudden we're going to get a half-point basis cut. Stocks are rallying in the hope that that's going to do the trick. It's not enough. I don't care if it's a quarter point, a half basis point. It's not enough. Meanwhile, job openings for July came in at 7.67 million, the lowest since 2021. Well, what was happening back then? We were coming out of COVID. We were in lockdowns. If this number is revised down again, job vacancies would likely be below the pre-pandemic levels. And if there's one thing that this administration is known for, is revisions to prior data. Why? Why do they rely upon revisions? Because the media will not report them. You need to show up here to hear about it. You need the alternative media to hear about it. Now, folks, if I could ask you, if you could smack that like button, it would really help me out because I'm showing one like, and that's me. Thank you very much. Now, we know that we have jobless claims that are rising. On a yield curve is rising. It's uninverted now. So the Federal Reserve is going to cut rates by a half basis point. Okay. All right. So what's the market saying? What are they telling us a story about here? Well, all you need to do is take a look at the CRB commodity index last week, and it had a rip your face off bullish key reversal. This cup handle formation is still intact. Now, I mentioned earlier a decline in the US dollar and the bond market. What if I already said that the US bond market is already in a bear market? Would you believe me? It would be hard to believe. I think I just had a bird fly into my window. It would be hard to believe that we're in a bear market, given the fact that we're a full percentage point below. Oh, you're showing 5 likes? Thanks, Tim. A full percentage point below where we were back in April. I'm still showing only 1. Excuse me. But the macro story is this. There are 2 types of bull markets and bear markets. One is your secular bull market. That is a bull or a bear market that can go for 20 years, 30 years, 40 years. Then you have your cyclical bull markets. They can last for 6 months to 2 years on average. So where are we at current? Well, here's the 40-year look at the 30-year Treasury bond. Now, keep in mind, the Federal Reserve has little to no influence over this bond price. They want you to think that they do. They don't. Shorter duration bond prices, yes, they do. The 30-year bond, very little influence because it's too big. It's too big. So here is the 40-year bull market, but that ended March of 2022. And we went into a bear market. At current, you'll see that we put in a higher low and we are rallying, but still we remain in a cyclical bear market. Yes, we have a cyclical bull market, and that's what's driving yields lower. What happens when or if or when we hit resistance? Right about where we're at right now, between 135 and 127. Last tick was 126.59 on the 30-year Treasury bond. What if this bull market, this cyclical bull market, comes to an end and we get the resumption of the secular bear market? Is that impossible to comprehend, impossible to think about? I think that it's completely plausible, because if you're able to have a 40-year bull market, can you not have a 10-year bear market? Can you not have that when you have a government that is spending more money than we've ever spent in our life as a nation, with our borders open, with the promise of putting these people on welfare, giving them Social Security so they have Democratic votes in perpetuity? It's completely plausible. And if you are looking to go to war with the world, why would anybody want to own your debt? What lunatic would want to own your debt, especially since you confiscated the wealth of Russians who trusted the United States, and you weaponized the US dollar and you threw them off the system? So we already are in a bear market in the 30-year Treasury bond. But what about the dollar? You need both, right? Because I've always said that when we're doomed, when the Treasury bond prices move lower for an extended period of time, along with the US dollar. That is a crisis of confidence. And our lifestyle here in the United States completely changes overnight, poof, like that. Because nobody will want to lend us money so that we could borrow to buy cheap stuff anymore. So what's the dollar doing? And this is the other problem the Federal Reserve is not going to want to acknowledge. There will be cause and effect when they cut rates. So here's the US dollar. What's it doing? What's it telling us? Is it saying, buy me? Is it saying this is a bullish setup? I would argue this is an extremely bearish setup. We have lower highs, and once we take out 99 and close there on a monthly time frame, we are in a new bear market on the US dollar. So again, is it plausible to go into a bear market in the US Treasury market? We're already in one. We're already in a bear market. We are in a bull market within the confines of a cyclical, secular bull bear market on bonds. And we are about to enter one on the US dollar. We are at the precipice. We are at the Rubicon. So while we may just get a rip your face off rally on a 50 basis point cut, it may not be long lasting. I think that's all I had. Let's do some chart requests. I'm going to log off a little bit early maybe and go join my family. We're going to go out to dinner a little while, a couple of cocktails. You know the deal. You're killing me here. What are you doing? Close. How do I drag this over? There we go. Okay. Okay. Let me go over to the forum. Did we get any more requests? Make sure I got everybody. Lots of activity here today. Good stuff. Okay. We're good to go. Let's do it. All right, folks, we're going to be using TrendSpider automated technical analysis. 35% discount code below. If you are not using TrendSpider, it's like an archer not having arrows in his quiver, folks. So I would encourage you, even if you're an experienced trader, you want to have this because automated technical analysis is awesome. It validates your support and resistance levels. It also lets you know when you miss something. You also get seasonality. What does well this time of year? You get scans. I did the best stock charts for the new trading week. I published that. When did I do that? Yesterday. So that's on YouTube. VKTX, Viking Therapeutics. Okay. So let's take a look at this is a monthly view of seasonality. This is not a good time of year, September, October, to be involved with this stock. So warning flag on the track. The however is it's looking pretty bullish. Very, very bullish. Nice. Nice setup here. Daily view. This looks like it wants to break out. Very nice setup here. I'm going to overlay Fibonacci's. We broke out above the 66.08 retracement level on the Fibonacci sequence on Friday. I like it. I'm bullish. Just beware of the seasonality. Use a tight stop loss. You may want to use a smaller position than what you would normally do, just in case that seasonality rears its ugly head this month and next. CORZ, Core Scientifics. I don't know this company. I love the chart. I'm loving this. On a weekly time frame, we broke out last week. I'd be looking to buy it on a retrace. Back down to support. I'm a buyer at around $11 a share, give or take a dime. Let's go to the daily view. Daily view. Oh, that's a 1 minute view. Sorry, I hit the wrong button. Daily view. Daily view looks good. You need a retracement here. I think it gets bought on that retracement. Not enough data to talk about seasonality. It's too new. Too new. We have Bud. I haven't looked at this chart in a long time. Let's go monthly view here. It's coming back. It's coming back. A lot of overhead supply here. I'm not a buyer until we get above. I'd like to see us above $69 a share. If you're going to scratch the itch, that's fine. I would do it at around $66 a share. And I would do it on a close. Oh, this is pretty. This is pretty here. This is another way to look at it using the monthly or weekly chart. Look for a retrace here. Back down to support at around 63, $64 a share. Okay, good stuff. So Bud looking interesting, but I would nibble here only on a retest. The real money's going to get made once we get the monthly breakout above this level here. $69 a share. We close above that mark. I think we're running up to the 80s pretty quickly. Let's go to LABU. LABU had a really good week last week. Weekly chart. You know, here's what I would do here. I would wait until we get a closing breakout. I don't want to be buying stocks, especially leveraged ETFs and biotechs, in advance of this FOMC meeting. I just don't want to do it. I don't want to buy anything. The only thing I might do is cover some shorts on the triple Qs, buy some TQQQ, and that'll make me more neutral on the market. And let's just see where the chips fall post Fed meeting. I don't want to put on any new net long positions or net short positions, for that matter, in advance of the Federal Reserve announcement. So I would wait for a close above weekly resistance here. And then I would be a buyer, but only after the Federal Reserve does their announcements. And ideally, we get a couple of days in the books. Because remember, the knee-jerk reaction to anything in this equity markets is usually the wrong reaction. It could take only several minutes. It could take a day or so. But you want to give it some time to sink in. Let the markets absorb. Watch how the bond market reacts. What if yields spike up? What if the 30-year, 10-year Treasury bond yield spikes up post-Fed announcement? Well, aren't yields supposed to go down? What if they already have? And you're not getting the bang for your buck that you thought you were getting? That's why it's best just to sit back, relax, wait. What if the dollar drops? Right? Dollar drops. CRB commodity index continues to go up higher. What does that mean? It means inflation. So no rush here. Weekly chart of LABU breakout. And we want to be especially careful right now, given the fact that we have a uninverted yield curve. We know what that is meant many, many times in the past. It means very, very bad things for the equity market. So that's my take on LABU. I'm bullish on it. I would wait for the breakout, though. If you wanted to sell some puts here, that's fine. I would go deep out of the money. I would be looking at a 20 delta, 15 delta, selling puts. Wheat. This is the ETF on wheat. You know I'm bullish here. This is uncorrelated to the U.S. equity markets. Therefore, I don't care what stocks do. I think that this looks good. This is probably going up higher. We likey wheat daily chart. Yeah, this is just strong. I just like wheat. Wheat's looking very, very good. Let's check out seasonality here. 13 years worth of data. We're in a seasonally favorable period of time. November gets really wonky. It's not a good month. I would be out of this trade by October. Sell the rip. Use a trailing stop loss order. Get out. RMTI, is that right? RMTI? Rockwell Medical? Make sure I got that right. Yeah, RMTI. Okay, good. Okay, weekly chart. It's probably going up higher. I can't buy it here. I wouldn't short this, but it is very extended relative to its. This is a 2 standard deviation. Let's play a game here. That's not what I wanted to do. Hold on. I wanted the Bollingers. I want the Bollingers. Thank you. We're going to flip this to a 3 standard deviation. We're trading above it. This cannot be bought. It doesn't mean it's not going up higher. It just means that the risk of a nasty, nasty sell-off is about to happen. I don't see a lot of resistance immediately above. Oh, we do have it on a monthly time frame. This is the value of Trend Spider, folks. So these are the automated trend lines on a monthly chart on Trend Spider. We're right at it. We hit it, and we backed off it. This is not a buy. I wouldn't short it, but I would not be a buyer here. You have resistance that has resulted in the past. The last time we hit this was back here in July of 2023, and we dropped like a rock. I'm not saying that's going to happen again. We have a much better base that we're rallying out of. I just wouldn't buy it from a risk reward perspective at these levels. I would avoid this stock right now. Let it come in a bit. Let it pull back perhaps to the rising 20 period moving average on a monthly chart, which is at current at around 225, 220, 230 per share and rising. I would not touch this right now. JD, JD.com. I believe this is a Chinese stock. Tight consolidation. Higher lows, a monthly chart. Really good consolidation. So, contrarian investing 101. When you're looking to buy a stock that's in a bear market, rule number 1, it must stop going down. Has it done that? Yes. Rule number 2, the stock must put in a higher low. Does it appear that we are doing that? Yes, it does. I'd be okay with a nibble because you have a logical stop loss point right below here at around 24.50 per share. I would add more aggressively on a breakout and a close above $30 a share. Then it's game on, especially if we take out this pivot point here up at around $36 a share. Then we've gone from a bear market to a sideways market to a bull market on a close above that mark. That's JD.com. That's the macro view. What might it do this coming week? I think it could go up higher or just trade sideways. I don't see a lot of downside here. So good. I'm sure they trade options, sell puts here, average down your basis cost. If you want to buy the stock, fine. Sell covered calls. Last one up, MELI, Mercado Libre. Monthly chart looks the bomb, looks really, really good. Weekly chart looking awesome. Nice breakout here. We may get a retrace. Wow, this is a $2,000 stock. Reminds me of Chipotle. Look for a retrace back down to 2,035 per share. You get that? I'd be a buyer. This is going up. Good looking stock that wants to go up. TZ, my wife is helping me look at some stocks for Thursday's show. I'm just charting the stocks we cover on Thursday and Sunday. Okay. All right, folks. Thank you for being here. I'm going to head out, get some dinner, and enjoy Salem. If you haven't been up here, it's a really great place to be. Thanks. And everyone have a great remainder of your Sunday, a profitable trading week. And members, I will talk to you tomorrow. And don't forget the Bulls Bear Banter trading forum, link below. It's free for now. TrendSpider, 35% discount code. Link below on YouTube, link above on Twitter. Everybody, have a great night. Talk to you soon. Be well.